All right, what's up guys? Scott here again with a new video. And for this one here, we're going to take a look at how the stock market is able to forecast its own future behavior or its own future volatility. And so this here is especially important for options traders, right? Because future volatility of the stock market, otherwise known as implied volatility, has a direct impact on option prices and therefore a direct impact on your option positions. And moreover, given the current bear market that we're in right now of 2022, right? Then analyzing this kind of information is going to be very useful as well, right? Because we're going to see, again, what the market is predicting about itself in terms of, is this crazy price action and this downward movement in stocks across the board going to end anytime soon? Now, also here, I do have some very exciting news I want to share with you all. So if any of you are interested in joining a very exclusive online community where you guys can really learn how to successfully trade options, then you can now join my options trading Discord. And once you join, you'll gain access to the following benefits. You will see detailed real-time trading updates from my personal live trading account. You'll get daily trade suggestions and ideas, alerts regarding important market news, events, and price levels. You'll get very fast and personalized responses to any and all questions. And of course, also, you'll be able to participate in very engaging discussion with other like-minded traders and investors, myself included. And so if that sounds good to you, then be sure to sign up today by using the link in the description of this video, and you'll begin your 7-day free trial. And then secondly here, for those of you who are brand new to the channel, again, my name is Scott, and you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you'll also find some links to a few of my introductory courses in the description of this video as well. So be sure to check them out, and when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. And then lastly here, be sure to watch until the end of this video, because at that point, I've got a very cool opportunity for you all where you can receive up to 10 free stocks. All right, so now diving in here guys, and first off, just to unpack a little bit the title of this video, right? Forecasting stock market volatility with VIX Futures. What does all that exactly mean? Well, first off here, what exactly is the VIX Index, which is what I'm showing you here in this chart. And so the VIX is an index just like the S&P 500 or the NASDAQ, for example, except the VIX Index shows you the implied volatility for the S&P 500. And implied volatility is a measurement of expected future volatility of, in this case, the S&P 500. And so in this case, for example, as you can see today, right now, the VIX is at a value of just over 27%. And so just as a side note here, implied volatility is always quoted in terms of a percentage. Now the full definition and conceptual understanding of implied volatility does get a lot more complex in terms of standard deviation and things like that. So just for the purpose of this video here, understand this one very important takeaway. And that is over a very long-term historical average. Basically, if you look at the VIX over many, many decades, the average value for the VIX is around 17 to 18%, way down here, right? Because most of the time, the stock market is not in a bear market like we're in right now. Most of the time, stocks are typically just grinding higher, or at the very least, just moving sideways. And in those kinds of market environments, you typically do not see a lot of crazy volatility or crazy price swings in stocks across the board. So again, in those times, which like I said is the majority of the time for the market, you will see the VIX at a much lower level. But then of course, in more rare situations like in this year of 2022, when stocks are just moving all over the place and mostly going downwards, of course with that comes a lot more volatility. And so that's why ever since the beginning of 2022, which was right here, we've seen a lot of very large spikes in explosive volatility for the market, right, when major sell-offs do occur. And then also from more of a bird's eye view here, we have seen the VIX steadily grind higher and higher. Now that being said though, the issue with using the VIX index to give yourself a possible forecast of what the future volatility of the stock market might be like is the VIX only gives you a single point in time, right? Specifically, this current value of the VIX of 27%, this is today's value. This is the only data point you have to go off of, or at least the only current data point that you have to go off of. And so the way you fix this issue is not by looking at the VIX index, but instead looking at the VIX futures market. And in case you're not aware, futures contracts are just a form of derivative, just like options. They're basically contracts as well between a buyer and a seller that do have an expiration date. And so now if we come over here and instead of looking at just VIX, we'll go to /VX. And then as you can see here, these are the volatility index futures. And specifically in this chart here, we're seeing the July contracts, which are basically right now the active month or the active contracts. But that being said, you can still go over to the trade tab here and take a look at all the expiration cycles. So right off the bat here, you can see a June expiration as well as a couple different July expirations as well. But if I were to scroll down a bit here, now you can see August, September, October, November, so on and so forth. And so even though the most actively traded contracts right now are the July contracts, the rest of the contracts are still being traded or could be traded right now as well. Just like options, right? You can trade options with any kind of expiration cycle that is available. And so then if you analyze the prices of all these different futures contracts here, this is how you can construct a forecast of future volatility of the stock market. Now doing so with just numbers here is a bit difficult to do, so we'll come over here now and I'll show you that in a visual form. And so this graph here is showing you the VIX Futures term structure, which is basically a way of saying this is a graph which on the x-axis here shows you all the different monthly expiration cycles. And then on the y-axis here, the actual prices of the VIX Futures contracts expiring in those expiration cycles. So for example, as you saw a moment ago, the VIX Index, which is shown here in green, at least at the time I took this screenshot of the graph, the VIX Index was just under 27%. And then the July VIX Futures contract has a current value of 27%. So basically very close to each other here. But like I said, the issue with the VIX Index here in green is that it only gives you a single data point, whereas the VIX Futures market gives you many data points. And right now the VIX Futures market is saying or forecasting increasing amounts of volatility in the market through the end of the year basically. Except for some reason in the months of November and December, it is expecting a slight drop off of volatility during those 2 months. But still, even in December here, the market is forecasting higher volatility than right now. And then finally, beginning in 2023, market volatility is expected to tick back up once again here. And so ultimately, there are two major takeaways from this graph. Number one here, regardless of the fluctuations of the VIX Futures term structure here, it is still expected that implied volatility for the S&Ps is going to be much, much higher than long-term historical averages. Right, as I explained at the beginning of this video, the average value for the VIX or implied volatility is around 17 to 18%, not in the upper 20s, almost 30%, as you're seeing here on this graph. And then secondly here, the second major takeaway is the fact that because the market right now is predicting increasing amounts of volatility through the end of the year, that means the current bear market that we're in right now is probably still only in its beginning stages. Right, because as I also explained, in most markets, which are bull markets or cyclical markets where stocks are just kind of moving sideways, you don't see a lot of crazy volatility. But in bear markets like right now, you will see a lot of volatility. So again, the fact that the VIX Futures market here is predicting increasing amounts of volatility much, much higher than historical averages pretty much indicates that the bear market here is likely going to continue. And then lastly for this video, what are the major implications of all this for options traders? So with current volatility very high right now and expected to increase further over the course of this year, that's going to benefit options sellers. Right, because implied volatility is used to price option contracts. And with higher implied volatility, that means option prices are going to be more and more expensive. And naturally, when it comes to options trading, it makes the most sense to be selling very expensive options. And then if you're going to buy options at all, to only buy them when they're very, very cheap in price. And so as an option seller, I do intend to still be very aggressive with selling options through the end of this year and all through the bear market of 2022 and possibly through 2023. And also looking at this VIX Futures term structure here helps me plan or strategize for my portfolio as well. So again, as I explained here, the bear market is likely going to continue for the time being. And so therefore, a lot of my positions and my portfolio as a whole is going to have a bearish bias to it. Now, does that mean I'm not going to make any more bullish trades through the end of the year? No, of course not. I'm still going to make some bullish trades every now and then to play for short-term bounces or bear market rallies, etc. It just means that generally speaking, my overall approach to the market is to play for a continued downside movement in equities across the board. So perhaps most of my trades will be bearish or have some kind of bearish bias to them, but that does not mean at all I'm not going to make any bullish trades whatsoever. right? Because it's still very important to have good balance in your portfolio. And as we've seen in the recent past, some of these bear market rallies can be very, very vicious. And so if you only have bearish trades on and you get caught in one of those situations, you could lose a lot of money. So ultimately here, guys, just taking a look at the VIX futures term structure on an occasional basis, just keeping this in the back of your mind is a very important thing to do. It does not mean these forecasts are always 100% accurate, but it just gives you a very good idea of what the general market is predicting about itself in the near future. And also, if you do want to take a look at this chart yourself, I will post a link to it in the description of this video below. And then finally in this video, as I mentioned, I do have a very cool opportunity for you guys where you can receive up to 10 free stocks. So basically, there is a newer brokerage company out there called Moomoo, which is based in Palo Alto, California. And again, for a limited time, they are offering you the opportunity to receive up to 10 free stocks when you sign up for a brokerage account with them using my link in the description of this video. And so the Moomoo trading platform is highly competitive with other comparable platforms like Webull and Robinhood. There are absolutely no trading fees on stock or option trades. You also get direct trading access to US, Hong Kong, and Chinese markets, which is something I have not seen being offered by competing platforms. Moomoo also comes with a free, very advanced yet totally user-friendly trading platform that you can install on your computer or your smartphone. And of course, everything is regulated by the SEC and FINRA, so your trades and your investments are properly insured. And so if that sounds good to you, then again, use my link in the description of this video to sign up and get your free stocks. And don't forget, if you also want to take some very detailed classes on options trading or stock market investing, then check out my SKILLSHARE courses. Links also in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.